Hey, how you doing? This is Adam Post. I haven't covered Warner Brothers very much at all over these last even couple of years because there wasn't that much interesting going on about Warner Brothers. But this is really interesting. It's a massive industry trend, and these guys are going to make a ton of money off this. I'm not saying to buy their stock, although their stock is up 11% today on this news. But I am saying this is going to be a good deal for them. One of the biggest problems that Warner Brothers has had is they're stuck with billions and billions of dollars in debt. When they took over Warner Brothers, the studio from AT&T, they did it in such a way that required a lot of debt, like around $50 billion worth of debt. Now, they've paid off $10 billion of that debt, but they're still stuck with around $40 billion in debt. By getting out of the cable business, by spinning off their cable channels, they can get rid of a lot of that debt, and they can focus on just making movies and doing things that they'd want to do with Warner Brothers, building up their streaming business, and not being stuck with this massive amount of debt and the dying cable industry. That's why Universal is getting rid of their cable channels, at least the ones that don't really make them money. And that's why Disney has even been talking about getting rid of their linear TV networks. But Disney's not getting rid of them. Disney doesn't like to sell stuff. And everything that Disney does is so intertwined with their intellectual properties and their other deals and accounting tricks. So Disney probably won't get rid of their cable channels, but Warner Brothers will. From the Wall Street Journal, Warner Discovery to restructure, setting up potential strategic opportunities. From the Hollywood Reporter, Warner Brothers Discovery takes steps towards separating TV channels from studio business. And it's more than a step. It's a very formal process of separating the TV channels out away from the separate studio business. It's not officially spun off yet. It's going to take them till mid-2025 to work out whatever they need to work out to have it all done. But when they have that separate structure, then they can figure out, okay, here's how we're going to spin this out. And from CNN, Warner Brothers Discovery stock surges as it restructures its business. It was up about 11% around the time of this video. We'll go through the Hollywood Reporter article and I'll comment and you'll see. They can create tremendous value just by separating these two businesses and taking debt from the main company and sticking it with the cable channels and then spinning it off. From the Hollywood Reporter, Warner Brothers Discovery takes steps towards separating TV channels. Warner Brothers, led by CEO David Zaslav, has become the latest Hollywood studio to rework its corporate structure with an eye towards a possible spin-off of its legacy TV assets. Warner Brothers announced it was reorganizing its corporate structure into a global linear TV division separate from its streaming and studios division. The new corporate structure aims to bolster its strategic flexibility and create potential opportunities to unlock additional shareholder value. The studio said it will begin the early steps towards the new corporate reorganization immediately and expects to complete the initiative by mid-2025. In a sign of just how embattled the pay TV business is, the move by Warner Brothers follows rival Comcast unveiling a plan to spin off less lucrative cable channels away from its film and TV studio entertainment and parks business. Disney CEO Bob Iger has also talked publicly about his studio's legacy TV networks, including ABC, saying they may not be core to the company. He's gone backwards on that and said, oh no, we're not going to sell anything, but you can imagine how people were freaking out who worked for those companies. I mean, they have thousands upon thousands upon thousands of employees, and hearing the CEO just casually say, hey, we may be spinning this thing off, we might sell these things, I don't know, we're taking offers if anybody wants to make any offers, and they did get an offer or two. Nothing all that serious. But it showed you Disney was looking at things pretty radically. Ultimately, Disney's not that into spin-offs, and they're certainly not big on selling big pieces of their company. They like to keep getting bigger and bigger, and they figured out how to do that, and for their part, pretty much make it work. Paramount Global's incoming CEO, Jeff Shell, said his company's plan would be to manage CBS a bit more aggressively for cash flow, given that the linear TV business is a declining business. At Warner Brothers, the plan appears to be spinning off all its linear TV assets into a separate holding company so that the core of the company can return to growth. Well, since the combination that created Warner Brothers Discovery, we've transformed our business and improved our financial position while providing world-class entertainment to global audiences, according to Warner Brothers President and CEO David Zaslav. Well, we continue to prioritize ensuring our global linear networks business is well-positioned to continue to drive free cash flow, while our streaming and studio business focuses on driving growth by telling the world's most compelling stories. Our new corporate structure better aligns our organization and enhances our flexibility with potential future strategic opportunities across an evolving media landscape. It helps us build on our momentum and create opportunities as we evaluate all avenues to deliver significant shareholder value, according to Zaslav. While the cable business used to be a cash driver for studios, the TV channels lately have become a drag on earnings, and investors have dinged companies that have been weighed down by channels tied to bundles that have fast fallen out of favor with consumers who've instead spent their money on individual streaming services. But the cable business, similar to streaming services, is a subscription-based business. They get revenue from the cable distributors, and they get a lot of money from the cable distributors. It's still a business that brings in a lot of steady money. The problem with the cable industry, if you own cable channels, is that you're getting less subscription revenue from the cable distributors and you're selling less advertising because less people are watching cable. They're watching streaming services, they're on YouTube, they're doing other things, they're on TikTok. But the business does still bring in a lot of steady revenue. When businesses like this go into secular decline, when they start to do badly because the industry itself is starting to collapse, there's still a lot of money there. Finance guys jump in usually and figure out how to aggressively manage it for cash flow, which is to squeeze expenses, juice the revenues as much as possible, and get all the profit you can out of it. Even DirecTV was bought by a finance company called TPG. AT&T, there's a lot of T's and letters in there, but AT&T bought DirecTV for around $50 billion and wound up having to sell it at a massive loss. TPG just made a deal recently to acquire 70% of DirecTV for $7.6 billion. That's a lot less than AT&T paid. But why does a finance company want to be in business on some kind of a declining asset like that? Why do they want to even bother to own something like this? Because they figured out how they can make a profit squeezing the damn thing. They're also buying Dish TV for $1 and taking over $9.8 billion in debt. For anyone that had money that was owed to them by Dish TV through that debt, they must be pretty happy about it, because if your company is basically worth $1 plus the debt assumption, that's not so good. So there are economics that work there. But if you're trying to buy into a hot business that has a lot of growth opportunities, you're not trying to buy into a business that's in a massively declining industry. And if you're a big studio and a huge chunk of your business is this massively declining industry, you don't want to be invested with that studio. Those two situations, like growth, lots of future growth, versus maybe we can squeeze some profit out of this declining industry, are two very different type of investments. So when you have people that are interested in investing in something like one or the other, and you stick those two things together, it makes the company a really odd duck. Not something that you'd really want to put money into, because you don't get what they call a pure play. You don't get one or the other. You're stuck with a thing that's not of interest to you. That's going to change when they spin off this company. Last year, major pay TV companies collectively lost about 5 million subscribers combined, and Comcast lost around 2 million subscribers. Under this new corporate structure, Warner Brothers will be the parent company for two distinct operating divisions. The global linear networks will hold the studio's legacy TV assets, including brands like TNT, TBS, and Discovery Channel, together offering content including sports, scripted, and unscripted programming. The separate streaming and studios businesses are a collection of linear cable TV brands like TNT, TBS, and HLN that face headwinds from cord cutting and an industry-wide march towards streaming. As Warner Brothers works to uncover the hidden value of key assets, the studio earlier unveiled a massive $9.1 billion goodwill impairment charge, which is a loss, to write down the value of its traditional TV networks. The advantage they have now because of that $9.1 billion loss is they can take that loss and they can cut it up any way they want to, pretty much. But it's likely that gets moved all the way over to the TV business, which gives it a tax advantage because they can take that $9.1 billion loss and apply it against taxes they otherwise would have had to pay from their income in the future. If they combine that business with other cable channels, like the Universal ones or wherever else they get cable channels or any other businesses, when they eventually do spin off that business, it's a huge advantage for that company to not have to pay taxes against that loss. It depends on the tax rate and how it's all figured out, but that is like a $3 or $4 billion asset for them potentially, that loss. You can also think of the massive layoffs they can do if they acquire other cable channels and smush them together with their cable channels through that new division. They will lay off a lot of people, which means they'll save a lot of money. And when they save that money, it creates even more value for them. Warner Brothers said it expects the new corporate structure to enhance clarity and focus, with each division positioned to deliver on its specific strategic and operational objectives while executing on initiatives to further key priorities for consolidated Warner Brothers Discovery. Which is a fancy way to say it lets people look at their business as two different distinct businesses until they do the spinoff of the cable channels, which of course they're going to do because that's how they're going to realize value. The value of that separate spinoff, even when they stick a lot of debt on it from their Warner Brothers acquisition, is probably going to be substantial. They will wipe out, you can mark my words on this one, a massive amount of debt with the debt that they stick onto this cable spinoff and the value of the new spinoff because they're going to still own stock, some percentage of whatever that spinoff is. These are some very sophisticated financial operators. It's going to put them in a really good position. I'm very happy for the company because they really did get stuck when they bought Warner Brothers and all of a sudden streaming assets and the studio's value went down like immediately as soon as the deal closed. They overpaid essentially probably by $20 billion or more. The studio added it will continue to evolve the board of directors to execute its strategy and drive future shareholder value creation. What they need to do is put a few people on their board of directors who will then become part of whatever this new spinoff is with all their cable channels. And the timing for this is really good. From The Hollywood Reporter, media deals outlook pent-up demand to fuel big year in 2025. Expect big M&A moves, mergers and acquisitions, in the media telecom sector, a closely watched forecast from accounting firm PricewaterhouseCoopers says. Because Trump's people are coming in, they're all about deals, and they're not looking to prevent companies from combining and wheeling and dealing and doing those kinds of things. The previous administration has been very difficult in that area, so a lot of people didn't even try to do deals because they knew it wouldn't have gone through. Warner Brothers is finally in a situation where they can get rid of a bunch of their debt, make money off of this spinoff, and focus on the studio and the streaming and what they really want to focus on. I don't make recommendations about buying stock or anything like that. I'm just happy to see these guys finally get out from under like an extra $20 billion in debt and create a situation where maybe they can actually make some really good movies based on the DC characters. Let me know what you think of all this in the comments below. Always love to see your ideas. Please be sure you are subscribed to the channel. Click the bell for notifications, give me a thumbs up, and I'll see you again soon with another story. And if I don't see you, I will miss you.